Hello and welcome to PCG Live. Now, following our last episode on the stability of the economy, today we're going to look at how upcoming elections might affect economic growth and what that all means for business. Discussing this with Trevor Williams, Chief Economist at Lloyds Bank, Jonathan Todd, Chief Economist at Demos, and Andy Chamberlain, Senior Public Affairs Manager at PCG. And remember, if you have any questions for the panel, get in touch with us on Twitter using the hashtag PCG. So Trevor, let me start with you first of all then. Generally, how would you say the current economic landscape looks?
I think for the UK it looks extremely good. We have growth of around 3 and a bit % set in stone, I think, for this year. Next year I think we'll still have growth probably around the 2.5% mark. I think there will be some slowdown. Clearly there are some potential issues with the way that growth is being driven by a reliance on domestic demand, in turn a reliance on households, in turn perhaps reliance on those households gearing up their balance sheets once again and maybe borrowing in order to continue to spend. But we also have a very favourable profile for employment with a strong increase taking place, unemployment falling. This is feeding into higher confidence for businesses that are selling to this rising demand from households, and a virtuous cycle of set in with business investment growth looking like it's picking up as well. So growth is definitely more sustainable and looks set fair for the next 18 months or so. Beyond that, there's some challenges.
There's some problems with productivity, aren't there?
Well, I think the flip side clearly of the strengthening of the employment outlook is that we've not seen the productivity gains because it's still outpacing growth in the economy. However, I think that once growth embeds itself more into the economy, and there are some signs that businesses are beginning to spend more on R&D and on capacity in terms of plant and machinery, then maybe the productivity position will change. But there's also another issue with productivity as well, by the way, which is how do we measure it? And it looks like for some fast growth sectors, it's hard to measure the productivity gains that are taking place. So for instance, how do you measure the productivity of those that are self-employed? They're starting businesses, and it may well be that this is disguising a true productivity figure. If you look at manufacturing, productivity growth there is actually positive. So the issues with productivity are in the intangibles area of growth, and a lot of that is related to services, and some of it is related to areas of the economy that are highly regulated.
Jonathan, would you agree that in the main it's quite an optimistic picture, but there are concerns about productivity? Do you look at productivity in a different way?
I'd be cautiously optimistic about the economy. I think Trevor's absolutely right to pick up on the importance of domestic sources of demand, because I think prospects for exports are perhaps not as rosy. Fiscal consolidation is going to continue, so we have to look to domestic businesses, domestic consumers. But I think we are looking quite positive in terms of domestic businesses. It's striking to me that over the past 4 quarters, investment has been a larger part of GDP than it was over the period from 1960 to 2007. So we're actually seeing quite large levels of business investment by historic standards. I think that should feed through to increased productivity as workers have more capital at their disposal. It's also important that businesses invest in skills as well as physical infrastructure.
Andy, Trevor raised a very interesting point, which was how do we measure the productivity of people who are self-employed? How do we, and how is that?
Well, it's an excellent point, and Trevor's absolutely right. We've seen a change in the labour market where we've got more self-employed people coming into it. In fact, there's now more self-employed people than there are people working in the public sector, so it's been a big shift. And traditional measurements of productivity have been based, it's kind of easier to see in manufacturing, for example. Self-employed people work very often in the knowledge sector. So they're selling the skills that they keep in their head, and they're selling knowledge, and it's very difficult to measure that. So it's something that we are trying to get a handle on here, and we've actually recently had our first academic research hub a couple of weeks ago, where we brought in academics from around the world, and this is one of the questions we're putting to them. We'd like to try and get some academics thinking about this, about who are these self-employed people, what's the work they're doing, and how can we measure it? Because we think that the picture might be a bit more rosy, even around productivity, than some people are saying.
So if there is a difficulty in measuring that kind of productivity, is it being underrepresented or overestimated?
Our belief is that it's being underestimated, that there's more productivity out there than is currently being accounted for. But look, I recognise that we're still not, we're still 4.5 million people. It's not the entire economy. There are other issues at hand here. But the bit that we're looking at, we think that there's an issue there around productivity that we might have a bit of a part to play in, and that's not being fully accounted for.
Okay. Well, let's move on and talk about banking, because that's the bane of many people's lives, not just independent professionals. What more could banks do to help small businesses, Trevor, do you think?
Well, again, I think it's a highly complex issue here, and it can be easily explained in terms of looking at the data. So the figures show that businesses are repaying debt. Now, why is that? That's the question we should ask. Is it because lenders don't want to lend, or is it, amazingly, maybe, borrowers don't want to borrow as much as they did before, and even more shockingly, they want to reduce their debt ratios. They don't want to carry the levels of debt that they've carried into the crisis of 2007-8, and they want to reduce it. And it may well be that this is actually what's going on. Of course, there are the issues with the banks and the fact that during the boom they lent a lot, maybe over-lent to over-borrowed households and private sector businesses because they wanted to borrow and banks made loans available. So again, we should have a nuanced debate about this because you surely don't want your banks to be unhealthy. You want them to be healthy. So the lending they do has to be lending which is sustainable, i.e. the money is going to be paid back at a rate which will keep them in business. And at the same time, borrowers want deals which means that what they do works for them in terms of generating better revenue flows. So I don't think it's as simple as what more can banks do. There's a bigger picture behind this, of course, which is that in the UK, we don't save enough. So there isn't a pool of domestic savings which is actually sufficient to meet all of the demand that there is in the economy. And money flows in from overseas to bridge this gap. The domestic banks never had the capability to meet all of the domestic demand for loans. And some of what's going on is actually the foreign lenders into the UK have pulled back. And part of what people think is a reduction in the amount of loans available at rates that people want to borrow is in fact the consequences of the shock which occurred in 2008-9 to those who damaged their balance sheets by overlending at too low rates, at too easy credit terms.
I understand what you're saying about it being a nuanced debate, but from a kind of, I suppose, from a small business point of view, or even from an independent professional point of view, when we talk about creating more jobs, that inevitably means small businesses expanding, and to expand, obviously, they may need to take on loans to expand, and they're the ones that we hear from occasionally within the media saying that they feel frustrated, that there's not a degree of flexibility that there should be.
Well, I think there are issues around the availability of loans in the UK in the variety of forms that maybe businesses wanted. But again, let me come back to the point about the data and what it shows. So SMEs in the UK, if you ask questions around what are your key concerns, cost of finance and availability of finance is actually lower on the scale than you think. They're not at the top, actually. Now, the CBI survey, admittedly it's for larger firms as well, shows that the three top concerns of businesses is actually the sustainability of demand, generation of profit, and return on the money that they're employing. And by the way, scarcity of skilled labour. They come before the cost of finance and the availability of finance. That may not be the case for very small firms, admittedly, and there may be more challenges there. But the corporate picture with regards to loan availability is not as simple as some of the headlines would suggest when you delve deeper into the figures that lie below those headlines.
Jonathan, how do you see the role of banking in 2014?
I think Trevor's right that it's a nuanced picture and there's lots of different issues, but I think if you drill down into particular sectors, you see different kinds of pictures from what you do. If you look at the generality, I do quite a lot of work on the creative industries, and three big issues that are raised by the creative industries are secure copyright, access to skills, and access to finance. So this is an issue that tends to be raised, whether there's as much, I think there's work to be done in terms of establishing how substantial that complaint is, but it's definitely something that is said.
We've got a question that someone submitted before the programme. This is Dan Martin, editor of businesszone.co.uk, which is on this topic. Is it time to forget about banks and concentrate on boosting alternative finance, which is more flexible and understanding of SMEs?
We've seen substantial growth in peer-to-peer lending, haven't we? Which I would think is a positive thing. I think banks, perhaps it's more for Trevor to say, but I think banks have made, I feel, substantial efforts to be customer friendly, easy to access for small businesses. But if peer-to-peer lending and other sources of alternative finance push banks to further raise their game, then I think that's all to the good.
There's also been a bit of a rise in crowdfunding, hasn't there? It's
Yes.
been a bit of a thing. So there are some more modern, innovative solutions that are out there, and certainly amongst the self-employed, you will see, the idea that as you used to think, I've got a business plan, I go to the bank, I ask for some money, that hopefully the bank gives me some money. Sometimes the bank used to say, you need more money than that, here's a big loan. That's changing a little bit now. That it's more about, you don't need that much startup capital to start some of these businesses. I'm not saying all of them, there will be some businesses out there that need the bank money. And then you might find in work hubs up and down the country, these people are getting together. Independent professionals are pooling their resources. So if they don't need to have that much money individually, together they get a little pot of money together, that can keep them going, that can get them up and running. They get their client, then the money starts coming in. They'd rather work in that way, as sort of like along the lines that Trevor was saying, than go and get a loan. That doesn't, it's not everyone, but you are seeing that.
In terms of what you're saying about preferences, it would seem to me that working for yourself, you're inherently carrying more risk than working for a company, and therefore taking on the additional risk that might attach to a bank loan.
Absolutely.
Might be less attractive, and therefore there may be some preference for growing organically through reinvesting your own revenue.
Yeah, I mean, it's a big risk. You go out there on your own, you're turning away from traditional employment, which your peers are doing, and they've got their safe, salary coming in. You're taking a risk. You want to do that because you can see that it's going to be a rewarding career for you. But you do want to minimize those risks, and the idea of going to a bank and taking on a huge amount of debt, that's the first thing that you do. That's your first step into the waters of working for yourself. That's going to put some people off, and if they can build it up in other ways, they will.
I'm sure Trevor's got more to say, but just to very quickly say, that speaks to why we need to move the debate on a little bit from not just here, but in general. I mean,
And I agree with both of the comments that have been made. I mean, they're fantastic. They're showing actually quite rightly that the desire of those that are starting up businesses aren't as quite straightforward as I'm going to go off and get a bank loan in order to be able to do this, because you live in a modern world and things are changing. And if you think about the variety of ways that loans can be advanced as well, it's not as simple as just a bank loan. So, for example, we would do so-called invoice lending. So someone gets an invoice because they've successfully sold something. They can borrow money based on the fact that that invoice has been issued and the bank knows payment is going to be made. So they'll advance them, I don't know, maybe 90% of the value of that invoice. They can get some of the money up front before waiting for it to come in, for instance. There's private equity firms that aren't just looking at large firms, they're looking at smaller firms. Banks sometimes finance private equity. They may lend them money. Then there's other forms of lending by specialist finance firms. And we may lend money to specialist finance firms who much better understand the level of risk in very specific areas of either the corporate or the household space because of their either IT capabilities, the history of the loan record of the people or the businesses involved, and they're much more willing to look into the detail of it and lend against some of that risk. And banks may finance some of these specialist firms in some of the lending that they're doing. And those actual firms have seen strong growth over the last few years. And then, of course, there's venture capitalist type lenders who are much more willing, and angel financing. So there's actually a whole variety of sophisticated loan capability out there other than just a bog standard term loan from a bank.
Yeah. I mean, if we get away from loans and just look at how else banks could help independent professionals, Andy, I wonder, do independent professionals actually need small business loans? Are there other ways that banks could help freelancers who don't necessarily require loans? And I'm thinking about things, for example, with helping them in some way to deal with late payments.
Well, I don't know. Late payment. That's a big. Late payments is a big issue across business, and as we would say, independent professionals are often the smallest business. They're often at the very end of the supply chain.
Yeah.
They're dealing with clients who are much bigger than them. There's a bit of the client has all the power, and they don't get the money as quickly as they might like. And cash flow is a big issue, and it can cripple a business when it's a new business and it doesn't have much money.
Can I say though, just to add a bit of flavour to exactly what Andy is saying, invoice finances deals with late payment because it means that they have an invoice.
Yeah, sure. No, I mean
so the answer is, for the late payment issue, the bank will take the risk of the late payment off your hands. They'll pay you, as I said, if you've got £1,000, they'll give you £900 and take the late bit of the payment off your hands. Yes, you've got to give up some of the final amount, but the issue of will you be getting it in 9 months, or 10 months, or longer than that time, means that you have the security of knowing that this is money you can now use and spend. It's in your account, and you can use it presumably to build a business further.
And that's a great. Well, I think that's a great service, and obviously you'd rather just get the money from your client, but if that's not happening, and you need the money to keep your business going, and the interest isn't too taxing on it, then it's a useful resource to have there, isn't it? And the other thing I would say about banking and the self-employed is actually on personal banking, because there is a problem sometimes experienced. I mean, everyone's finding it a bit tough to get a mortgage these days because house prices are so high, but the way banks traditionally lend to borrowers around mortgages is that they say, okay, bring in 3 months pay slips then, and then that's where we'll start. That's the first hurdle you've got to get through. Where you're self-employed, you don't have that. So I just think that as we see more and more people going in self-employment, and there's no doubt that this is going to keep growing. It's been growing. It's been growing so much since 2000. It might be something that the banks might consider is, what do we do about self-employment? Could we be more flexible in how we loan to them personally? Because that is a challenge, and that does put some people off going in. That's the type of thing that puts some people off going into self-employment.
Typically, it's 2 years of accounts, isn't it? Banks would look for.
Yeah, I believe so. So again, I wonder. Look, I appreciate banks have got to make sure that their loan is secure, and we've just had a bit of a problem in the economy around issues like this. I'm not suggesting that banks just go out there lending money to it, but I just wonder whether it could be something that could just be reviewed with an eye to make it some sort of flexibility, allowing some sort of slack for the fact that self-employed people don't have such a straightforward issue, but they might have a good business there. They may well be a very good customer for the bank. So don't just write them off because they don't have their pay slips.
As we've said, it's quite a diverse pool of people who are self-employed. So maybe for banks to go further on that, they need to have better understanding of exactly what kind of self-employed person is coming forward.
Yeah, I think. Well, you touched on a big issue there. Who are the self-employed? And there's been a big debate around this, and it's something that we're very. This research hub I mentioned is looking into this as well. We'd like to. There's an argument going on, isn't there? So some people are saying, oh, it's fantastic. These are all people who are going out there. They've taken a positive career choice to step into the world of self-employment. And then there are others who are saying, no, these are people who can't get a job. These are people who are perhaps being forced into this road somehow via some arbitrary employment agency, which is sort of, putting that stamp of self-employment on them. Some people may not even know they're self-employed. Some people might think that they're an employee they're working at a warehouse or something, but in fact they're not. Now, I think that the truth is it's likely to be a mixture of those factors. And if we're going to really talk sensibly about self-employment, if we're going to come up with sensible policies, whether it's the bank's policies, whether it's the government's policies, whether it's business and how they interact with them, we probably do need to get a handle on who these people are, what different constituencies make up this overall population, and what's driving this growth in them.
Okay, let's move on from banks and talk about elections and referendums, etc. We've got a couple coming up. Obviously, we've got the Scottish referendum in September general election next year. In terms of the Scottish referendum, how do you think the outcome, obviously we don't know what it is, but two possible outcomes, would or might affect economic growth, Jonathan?
I think the polls are pointing towards a no vote, and I think that businesses' expectation has been of a no vote. It's not impossible that we could see a yes vote, and if we do see a yes vote, I think because businesses have not factored that into their future planning and forward expectations, that could be could be significant economic consequences of that.
It's foolish, isn't it, not to factor in something that could happen?
Well, it could happen, but I think it's a relatively low probability. I know, not it's
depending on which poll you look at.
But also, it's not issues around Scottish membership of the European Union, access to the pound, membership of NATO. There's all kinds of uncertainties that come into play in the event of a yes, which don't come into play in the event of a no. So even if you take into account the probability of a yes, which is a smaller probability than a no, there's inherent uncertainty attached to that yes, which doesn't attach to the no.
Trevor, what do you think about the idea of looking at both and preparing for both possibilities? Something that people should do, or should they err on the side of the no vote?
Well, I think it clearly depends on the extent to which you think, as a business, you will be impacted by this directly. And
what about banks with their headquarters in Edinburgh, for example?
Well, a few of them have said that they'll move, haven't they?
Yeah, well, I think you've answered it, haven't you?
That's our message for Scotland.
Couldn't possibly comment, but
I mean, those in the Yes campaign will, of course, say, look, we recognise that there'll be disruption. You know, the no vote is the no disruption, isn't it? You know, carry on as you are, status quo. Businesses always say, the one thing they always go on about is they like certainty. Elections are inherently uncertain, so they're never that welcome. This one, well, we've never had anything like it before, so it's even more uncertain than anything else. And really, I think there's bound, if it was a yes vote, there's bound to be huge ramifications economically and for business. And if you've got your headquarters in Scotland, but you do a lot of business with England, then yeah, you're going to have to think about relocating the whole thing. It's going to be a huge upheaval. However, the yes voters would say, well, we know that there's going to be disruption, but that doesn't mean it's not right, and it can still work out well over the long term. Short term, there's bound to be a few fairly major problems, but in the long term, we might have a better situation. I would agree with Jonathan that it's pointing towards a no at the moment. The yes, it feels like the yes peaked a few months ago. It felt like they had real momentum, and that seems to be dying away a little bit now. But I wouldn't want to be complacent about it. I mean, as you say, I think it's 12 weeks away. 3 months, things can still happen. Yeah, we'll see.
In terms of the general election then, which is obviously less than a year away, how does that impact people's behaviour and decisions? Because, you know, we have this government that's been in for 5 years. They had a particular plan. The plan seems on paper to be working. If, you know, the people in charge were to change, what might that mean for the economy, Jonathan?
Well, who knows what Prime Minister Ed Miliband would bring, but I think that's
it's in the manifesto, isn't it?
I think that it's an important task for Labour and Ed Miliband over the next 12 months to reassure business and the wider electorate that there wouldn't be any dramatic negative changes in the event of a Labour government, and I'm sure Labour will be trying hard to do that. I think Labour wants to focus on longer-term productivity challenges of the economy and perhaps import some of the German ideas, but I don't expect any kind of sudden dramatic change of direction.
Well, it's interesting because, I mean, you say that, you know, that it's in their manifesto, etc. Obviously, we don't have their election manifestos yet, but we are on a pretty good course right now. But the opposition, Ed Balls, etc., have said that you know, George Osborne is still not doing the right thing. He's still cut too far, too fast. Not really accepting necessarily that it seems to have worked. So that would suggest that they might do something different.
Look, I think the economy has long since moved past the stage where we need to be looking at palliative measures or stimuluses. I think we are, as we discussed in the first question, set for a period of non-expansionary continuous growth, certainly over this year, and I think over the next. There's not really strong inflationary pressures, and growth is going to continue. So that's a happy situation for the next 18 months, 2 years. Therefore, I think what politicians should focus on, what Labour should focus upon, is the longer term picture and using the tools which are available to the government to increase the UK's long-term growth rate and long-term productive capacity.
Let's talk about interest rates, shall we? Whoever I ask this question to when I'm sitting in this chair, I get a different answer, which is always interesting. So I'd be interested to hear what you have to say. Do you think that the Bank of England is going to increase interest rates before 2015?
You mean in 2014, therefore?
Yeah.
Well, it could be early next year.
I mean, the financial markets are predicting, after comments from the governor, that it might be November, but they're pushing it back now towards January of 2015. Obviously, there's a variety of views around this. It's not even, remember, the MPC haven't made their mind up that far ahead. They are looking at the conditions that face them when they're making the call on the meetings that they have scheduled and the data that's available to them. So what is the data telling us? The data is telling us that inflation's at a 5-year low, that wage inflation, a major component of price inflation down the road, is actually very low. Even though employment is growing, it seems to be growing in a way which is non-inflationary. So why would you necessarily, on that basis, think that you need to move quickly? And even if they did move early, remember that it's likely to be modest and gradual, because the challenges that the economy face, high levels of debt, high levels of gearing, are still there. And if you're having non-inflationary expansion, then why would you do anything other than move gradually and cautiously?
And you agree with that?
I would agree with all of that, but just to add kind of 2 reasons why you might want to. I would expect to see a 0.25% increase either later this year or early next. And I think 2 reasons for that are, we have an extraordinarily loose monetary policy for quite a long period of time. Therefore, a very small increase in interest rates signals a return to normalisation, and we have to accept that monetary policy can't be run forever as it has been over the past 5 years or so. And secondly, as Trevor's saying, what would be preferable is to have a gradual increase in interest rates over time, rather than allow a situation to develop a couple of years down the road where inflation is in a different position from where it is now, and we need to move very quickly with upward movements in interest rates.
I would say I don't know.
Don't worry, I wasn't going to ask you.
I don't think anyone really knows today. That's the thing. We can all just speculate on it.
Yeah.
But it seems like Mark Carney said, when he said a few months ago, that if I will raise interest rates when unemployment dips below 7 million, and maybe he thought that wouldn't happen, but it seemed to immediately happen. So then, ever since then, everyone's asked him, so you're going to put interest rates? You're going to put interest rates up? And he's sort of had to back away now because he doesn't know, as Trevor said.
Well, I mean, he's answered it. He hasn't raised it.
Yeah.
And it's now 6.6. Yeah. So it's clear that it's not the right time. And I think your points are right, Jonathan, around reasons why when you move, you move. But the question is around what affects the timing of the move. And I think the timing of the move, as we've said quite rightly, as Andy said, we don't know when the right time will be. In a sense, the right time will be when we move. But I think clearly the fact that the economy is recovering in a way which isn't generating significant price or wage inflation suggests that they'll be cautious about the timing of the move. And I totally agree that this was cut to 0.5% in March 5 years ago on the basis that the prospect that faced the economy then was significantly worse than anything that had been seen clearly for about a century. And that since then things have recovered. And so why would you leave rates as low as they have been? Well, I think the reasons are still there why they have, which is that we're still carrying very high levels of debt. Interest payments have been kept to low levels so that people can better manage their balance sheets and give them time to adjust. So the key question is, have they adjusted enough for the period when interest rates go up, and the consequence of that is felt, which is that the interest payments on debt will increase. Are you prepared for that?
Okay. Well, thank you to all three of you. That is all we've got time for today. Thank you for watching. Thank you to our panelists, to Trevor Williams, Jonathan Todd, and to Andy Chamberlain. And make sure you tune in for our next episode, which looks at freelancing in the PR industry. For now, though, goodbye.